Welcome back, traders and investors. We have Leigh Drogen on, founder and CEO of Estimize. How you doing today, Leigh?
Awesome. Thanks for having me.
Okay. Tell us about your company.
Sure. So I run a platform, a web platform called Estimize.com that basically crowdsources EPS and revenue estimates from traders, investors, asset managers, independent research analysts, industry experts, students, and everybody else. And what we do is we take all of that data and we run some algorithms through it to make sure that it's all clean. We weight all of the estimates in a consensus based on how much confidence we have in each analyst. And then we rate and rank everybody, and we give them all the intelligence, and the whole thing is completely free on the front end because we just want the data, and we want to give everybody a better look at consensus and all of the individual estimates that go into it.
And how do you decide who who you decide to take the data from?
So we're very agnostic to that. I think it's part of our philosophy as a company, and kind of where I come from, and that is that we don't really care. We don't really care whether it's an MBA student at Harvard, or whether it's the senior analyst at Viking Global, or whether it's some random investor out there. We consider all data to be good data. All data is relevant data. We know that when we have a consensus that comes from a lot of different biographical backgrounds of different people, it's on average much more accurate than when that consensus is only from a bunch of large buy-side analysts or only from a bunch of independent traders. So we want everybody in the pool, and we don't necessarily care how those estimates were created in terms of, are you running a big earnings model and talking to the company, or did you lick your finger, stick it in the air, and decide that was your estimate? And that's because we can measure all of this stuff so well statistically that we kind of know how you made the estimate. So we know when you went to the page to make the estimate, did you sit there for 5 minutes and play around with it a lot? Or did you come to the page and put two numbers in there directly? You knew exactly what the numbers were. And all of these things contribute to give us more or less confidence in the estimate. And we're able to do a really good job of figuring that out without actually talking to you about how you made the estimate.
And this is just not related to stocks and earnings forecasts, right? You do economic numbers, GDP, jobs, CPI, correct?
Yeah, we about 8 weeks ago we launched about 20 different economic indicators, and it's going really well thus far. And I think we can do better than the Bloomberg or FactSet or Thomson Reuters consensus there. That is basically just 30 economists, and we all know that the economists don't always get it right. So if we can pool together a couple hundred people from a lot of different perspectives, we should be able to create a much better, more accurate, more representative consensus. And so far, it looks, early on, and it's not statistically significant yet how much data we have, but it looks early on like that's the case as well.
Okay, Brentster has been following Estimize since you started, and he would like you to explain how your ticker coverage, has been able to expand. When he first started following the site, there were only a few companies covered, but how many do you cover now?
Yeah, so we now have coverage on about 1,000 names every quarter. And that's, as you said, significantly expanded since we started. When I started the company and we launched the platform, because we have this very interesting philosophy that we don't do any kind of a give-to-get model. You can go on the site, you can see all of the data for free. We don't ask you to contribute unless you want to contribute. And we do that for a very specific reason, because the self-selection bias of who contributes is one of the things that makes the platform so accurate. And about 75% of the time, our select consensus numbers are more accurate than the Wall Street numbers. And so when I started the company, there wasn't a great way to go out and ask people to contribute because there was nothing there in return. So it took a little while. It took about a year to really get the platform going, and then all of a sudden there was all this data there, and our coverage expanded from like 200 to 300 stocks, and it really ripped all the way up to about 1,000 stocks pretty quickly over the course of like 2 quarters. And now we've kind of plateaued out a little bit around 1,000 stocks, and we're going to be doing some stuff on the platform real soon that should kind of entice people to add more coverage deeper down into that list. We'd like to get it eventually to about 1,500 names under coverage.
Wow, and that's all just U.S. stocks then, correct?
Yes.
Okay. All right. So you're trying to, do the crowdsourcing for the earnings estimates and stuff, and you have your big companies, your big caps, S&P 500 stocks that are pretty consistent, with their earnings. But to me, this would be more important for like momentum trading of growth
Yep.
stocks. That's where it's got to be really come in handy. So, can you talk about some of the names you like there and maybe some of the names you don't like?
Definitely. Yeah, so that's exactly where our platform is valuable. We're not going to add a lot of value on Coca-Cola, right? Because there's no reason for the sell side analyst to have any kind of a skew or bias in publishing numbers on Coca-Cola that aren't quite realistic. But when you look at stuff like Michael Kors, a stock that I like, I think it's going through this huge growth phase right now. I used to be a hedge fund manager, and the strategy that I ran really centered around looking for stocks that were growing revenue at over 30% year over year, matched with momentum factors, as well as beating their analyst estimates in the previous couple of quarters and having their estimates for the current quarter raised significantly. And all of these factors come together to often, continue the momentum for the stock. And so when we look at the stocks that are really valuable in terms of the coverage that we have, it's really those mid-cap growth names that matter. And that's largely because mid-cap growth names often do a lot of investment banking. And there's often a lot of variability in how hedge funds and asset management firms view the company, in which case they need to be talking to the CFO and the CEO on a regular basis. And those are the two things that a sell-side analyst really does. They connect the hedge fund or the asset management firm with the corporate, or they do investment banking work. And because of that, they don't want to piss the company off, and their estimates aren't necessarily as accurate as they could be. And so what you see with Michael Kors on the chart here is that the sell side, basically the consensus is right at the top end of the company's guidance every quarter. The company sandbags their guidance by about $80 million on the revenue side every single quarter, and our consensus ends up being much more accurate and representative of true expectations. So when you look at whether the company beat or missed the estimates, you need to be looking at the Estimize consensus there. And they've done a pretty good job of beating the Estimize consensus as well over the course of time. And you've seen the stock, basically go bottom left, upper right of your chart over the past, year and a half. So I really like that one. A name that I don't like because it started to, over the past year or so, get on the other side of that trend is LinkedIn. I was a huge LinkedIn bull, basically, throughout most of that run-up. But what we started to see, and as a momentum trader, this is what you don't want to see in the stock. After a big run in revenue growth and the company starting to really generate EPS off of that revenue growth, as the revenue growth slows down, and for LinkedIn, it's slowed from about 81% year over year to 46% over the last year, or that last year and a half. The EPS growth has also gone from 200% year over year to negative 16%. So not what you want to see in a momentum stock, and the stock has obviously gotten crushed. And LinkedIn has not shown any ability to turn that trend around here. As well, they started to miss or come in line with their Estimize EPS and revenue consensus numbers, and again, not what you want to see from momentum stocks. So that one is kind of in the penalty box until they start to turn that trend around.
Do you have any plans for different kinds of crowd-based modeling, like crowdsource discounted cash flow or sum of the parts analysis?
We do. So we're going to be doing EBITDA and margins eventually. We're probably about 6 months away from that. And then after that, I'd say we're about 12 months away from going into the items. So iPads, iPods, iPhones, bookings, disaggregating all the different parts of the business and taking estimates on that. And we'll probably also do interesting stuff around private companies. We started an experiment around that probably about 9 months ago. And we got some pretty good feedback. So I would like to collect KPIs from companies like Uber and Airbnb, stuff that's really important to the market but isn't yet public, where EPS is not necessarily the important thing for these companies. It's really revenue and the KPIs. So like nights stayed for Airbnb or rides taken for Uber, number of drivers for Uber. These things are extremely important, and there's nobody collecting those KPIs right now. So I definitely like to do that.
Okay, so just the average investor, let's say they just tuned in, they see Estimize.com here in the chat room. Just how can the average investor, or trader, someone to portfolio, what's the best way for them to utilize your site?
Sure. So holding through earnings, if you're a trader, is a scary time, obviously, and there's a lot of information that comes out, and you need to understand it real well. When companies report earnings, and I remember I used to do this when I was a kid, and I was a trader, and I didn't know any better. And the company reports earnings, and the Wall Street estimate is 60 cents, and the company reports 62 cents, and the stock gets crushed the next day. And you sit there and say, but they beat the earnings. Why are they down so much? They did better than expected. Well, the truth is they didn't do better than expected most of the time in that case. The real expectation from the buy side or the independent analysts was at 65 cents, and they missed that number. And then maybe they guided down, and there's all sorts of other things that come into it that if you don't have all the information at your fingertips, you're kind of left wondering why. And it's not necessarily about making a trade ahead of the earnings. It's really just about having a full picture of information. So coming to the Estimize site, looking at the data, understanding where consensus really is, understanding how consensus has moved over time, because that historically is very highly correlated to equity direction. You don't want to be trading stocks on the long side where their EPS and revenue estimates are significantly falling throughout any given quarter. The sentiment is not in your favor. So making sure that you're looking at all that data. Getting educated regarding how these estimates are made, and actually putting estimates into the system can be very valuable. And we've seen, again, MBA students benefit a lot from that. And then on the trading side, specifically looking for ideas, we know there's a very large correlation between the gap between the Wall Street and the Estimize consensus in the 2 weeks before the earnings report. So let's say there's a stock where the Estimize consensus is 60 cents, the Wall Street consensus is 50 cents. If that's a momentum stock that's moving pretty well, you can bet that stock is going to outperform the market in the 2 weeks before the earnings report, and that might give you even more conviction to get a little bit heavier in that stock. So there's a lot of different ways to use the Estimize data set. The Deutsche Bank quant research team wrote a really big research paper on our data about 2 months ago, and it's available on the website.
Okay.
So we can obviously send that over, and it provides a lot of different intelligence on how to use the data set, and it's become pretty valuable.
Okay, we've had Leigh Drogen on, founder and CEO of Estimize, walking through his site. And do you have time here to talk about an individual issue? Rob Hood, Rob Hood just popped in here with RAD, and that's Rite Aid. Not sure if they've already had earnings or not. Yeah, they did, and they plowed it on that. Do you have any data available on RAD?
Yeah, so they'll report on the 19th here. And it looks like the Estimize consensus is right at the top end of the Wall Street range. So Wall Street's at 7 cents, Estimize is at 9 cents. And on the revenue side, let's just take a look here. We're basically in line. Wall Street's at 6.4 billion, and we have 6.407 billion. We're at 6.41 billion. So on the revenue side, not too different, but on the EPS side, significantly higher there. And Rite Aid's done a pretty good job of beating their EPS estimates over the last couple of years. And let's just take a look at the table for growth. Pretty stagnant on the revenue side, so not a typical momentum name, obviously. And on the EPS side, a lot of variability given some small numbers. Not the kind of stock that I would be in my strategy there, but let's just take a look at the price chart for a second here.
Yeah.
So obviously Yeah, obviously a pretty good trend there over the last couple of years off of a pretty low base. So stocks run a lot. It's come down a little bit into the report here. I would expect this stock to do pretty well over the next week, given the gap between the Estimize and the Wall Street consensus. But I don't have any good kind of intermediate term feel for the stock, given that it's not quite in my wheelhouse.
Okay, and the Brentster wants to do some real live back testing here. How did you do on Lululemon results today?
Oh, we nailed it. So the estimized consensus, let's see, was estimized consensus was 35 cents and 386 million. Company came in at 34 cents, 384.6. The street was at 32 cents and 380.3 million. So estimized consensus was a lot closer. And here's the really interesting thing about that. We know that there's another trading strategy associated with the estimized numbers after the earnings report, and that is what happens when there's a discrepancy between Wall Street and Estimize regarding did the company beat or miss. And it turns out that in this case, the company reported in the middle of Wall Street, which is at 32 cents, and Estimize at 35 cents, even though we were closer. We would expect, because the company missed our numbers, the company to underperform the market over the following 3 days. And so that's what we're seeing out of Lululemon today, obviously. And there's a lot of other factors that obviously go into how the stock will trade, given guidance and all these other things. But we do know, based on our back tests and our white papers and the Deutsche Bank white paper and other academic papers, that this strategy works. There's about 35 basis points of residual returns in the 3 days following the earnings report for when this situation happens. So something to just keep in mind when you're trading stocks after the report, that you might be able to get it a little bit cheaper.
A lot
if
cheaper.
you wait a couple of yeah,
A lot cheaper. The
might be
case.
able to get it a little bit cheaper.
Okay, all right. Leigh Drogen, founder and CEO of Estimize. Very interesting, and we're going to have to get you back on at the beginning of earnings season next time, right? Instead of the tail end, and see what Estimize has in store for the next quarter. But very good stuff, Leigh. Thanks a lot for coming on. We appreciate your time. Have a good day. We'll talk to you soon.
Awesome. Thanks for having me.